I want to talk to you today about how to value a business and how to value a company. And importantly, what's the difference between the business value, the goodwill value, and the company value? Now, the most commonly used valuation methodology is called the capitalisation of future maintainable earnings. So we work out what our future maintainable earnings are. Importantly, we might look at the past to predict the future, but it needs to be future focused. These are the earnings that we think this business is going to be able to earn on a consistent, on a maintainable basis into the future. We then multiply that by the capitalisation multiple, and I'll talk in the blog accompanying this video in a bit more detail about capitalisation multiples, but the most commonly used multiple in small to medium enterprise land is 3 times earnings. So in this case, if it was 3 times future maintainable earnings, that gets us our value for the business. Now, importantly, and this is commonly misunderstood, that business value includes a number of net business assets, or that's what I call them. They're the tangible assets, the working capital requirements of the business that are required to enable this future maintainable earnings to be derived. For example, stock. You might have some debtors, you might have some plant and equipment that you require. We deduct the net business assets necessary for operating the business from the business value to get the goodwill value. We then substitute that goodwill value basically into the balance sheet of the company. We're adding in surplus assets, taking off surplus liabilities, and it's when we plug that goodwill value into the balance sheet that we get to our company value. Now, we will make adjustments to the balance sheet items. For example, maybe income tax hasn't been accrued for the year. Maybe the leave liabilities haven't been taken up. Maybe there's an asset on the balance sheet that's no longer recoverable or no longer exists, and we'll take that off as well. Now, the company value will change every single day. Every day you're going to get some money in the bank, maybe you're going to raise an invoice, and therefore the tax is going to change. Therefore, the cash at bank balance is going to change. Anyway, I hope that helps you understand the 3 different types of value that we commonly prepare valuations for: business value, goodwill value, or company value.